Hey guys, welcome back to 90 Seconds with Chris. Today's video is going to be on negative interest rate and what this actually means for the economy. Quick recap, let's go back and understand how interest rates work. The Fed controls interest rate by manipulating the federal funds rate across the economy. See my video on federal funds rates, link in the description to understand more about this. Anyways, when the Fed raises interest rates, this causes people to borrow and spend less, and as people are borrowing and spend less, they tend to save more, which cools off the economic activity and controls inflation. On the other hand, when interest rates are lowered, people tend to spend more and borrow more because it's a lot cheaper to borrow other people's money and spend that while you invest yours. This anyways causes the economic activity to pick up and the economy starts booming. Now, if interest rates get so low that they become negative, does this mean we get paid to actually borrow money from other people? The short answer is maybe. One way banks make money is by depositing a portion of their balance in the central bank's Federal Reserve and earning interest on whatever they deposit in there. In the case of negative interest rates, however, banks don't get paid interest. Instead, they get charged a fine for having savings in the central bank's Federal Reserve. This will incentivize banks to lend out all their extra cash to the public, thus boosting the economic activity as a whole. With normal interest rates, lenders get paid a fee for taking the risk of borrowing out money. But with negative interest rate, this means borrowers could get paid for borrowing money. For example, a bank could lend a different bank $100 today and get back $90 due to a $10 negative interest. But however, this could be a good deal because if the bank decided to keep that $100, they could get charged a fine of $20 just for keeping that $100, meaning they only have $80 left. In this situation, the cost of keeping the money was a lot more than the cost of lending it out. Negative interest rates are actually controversial because it turns out that banks can actually pass on the fees they get to the customers like you and me, meaning that we would actually get charged for putting our money in savings account rather than getting paid interest on this. But it could also mean that we'll have to pay back less money than what we borrow. That's it for the video, guys. I hope it was helpful. See you in the next one.